But let's get in a fundamental voice as we speak about Reliance Industries and the broader markets as well. Nilesh Shetty, Associated Fund Manager of Quantum AMC, joins us right now on the show. Nilesh, good having you. Thanks so much for taking the time out. This is Neeraj here. Good afternoon. What's the sense, Nilesh? A lot of people, a lot of articles globally and locally speak about how we've had a bit of a rally and now we may be hitting a bit of a roadblock. If we cross, then it's well and good, but otherwise we may well see a trail downwards. What are you doing? Are you trimming positions or are you still going ahead with the longs if you had them in the first place?
No, the existing positions are continuing as it is. We've had to trim a few because the quality names have risen recently in the market. But our cash levels are slightly more elevated than we would like. But the good ones are very expensive, and we've not had the opportunity to pick up these stocks at levels that we would like them to. Markets are, even though broad markets are cheap, the good ones are fairly expensive. So the cash levels in the fund remain slightly elevated right now.
So then what's the call then? I mean, the good ones are expensive. The bad ones are something that a lot of people might not be wanting to buy. So stay on cash for the time being and hope for the market to go down, or wait for some more triggers.
So R is a more bottom-up approach, and it's a stock-specific approach. So as and when the stock buys are triggered, we would deploy the cash. Otherwise, we tend to hold on to the cash, irrespective of where the market level is. There are few stocks which are getting closer, but right now we've not had the opportunity to deploy cash in these stocks.
Right. What is your own view for the market as we close out or as we head towards the last 4-5 months of trade for this year? Do you think that the market has potential to go higher from here, perhaps retest its 2012 highs, or will it be a readjustment within this range with 5,000 as being a base?
Well, at least our sense is the broad corporate numbers have not been as bad as the sentiment suggests. I think overall corporate numbers have been fairly okay. The GDP numbers are at least our sense is slightly understated. I think real activity is slightly more better compared to what the GDP numbers suggest, and at least the flows indicate that foreigners have a bit more confidence in India. But all you need is a bit of turnaround in sentiment, and that will drive private capex, which will perhaps be reflected in better infrastructure spends, at least going forward. But the numbers have been not as bad at all. And at least we remain slightly bullish for the longer term.
The whole talk around policy action and what may happen to specific sectors. I'm just reading some lines out wherein the new date for the spectrum auction has been set as well, Nilesh, November 12th. But just broadly, keeping that as a parameter, what's the call on telecom? Because those stocks have been taken to the cleaners the last few days. I mean, forget an Arcom, which is now available at what, 50 odd bucks, but even a Bharti Airtel at 250, not that idea has had some very heady days either. What's the call really on telecom?
The sector story is not that great anymore. I think these stocks have had to go through a derating, but our sense is most of that is in the valuation. But whether they will continue to outperform is not a call. I think if you, at least our sense is the positions that we've had in the sector are continuing. They are not, at least the valuations are closer to especially buy levels in some of the stocks. But increasing positions or allocating more to the sector is not a call that we've taken right now. But existing positions are not, we're not looking to trim these positions primarily because valuations are at a lower level, or compared to history, it's fairly favorable right now.
Okay, so where is it that you're finding favor then? I mean, you mentioned that you're looking at stock-specific calls as opposed to doing a broader market call, and you're sitting on elevated cash levels. So where is it that you're finding favor? What is it that you're looking to add, if at all?
So the last two stocks that we added were primarily regulated entities, and these are government policy-facing companies which have taken a hammering on valuations and the stock trigger buys. Our sense is the problems for these companies were temporary, and I think slightly longer term these companies would do well. Incremental cash flow has flown into financials, into automobiles, where valuations are slightly more favorable right now, given that we've come off a high interest rate environment. But primarily the larger overweights right now in the sector remain financials and consumer discretionary, and within that automobiles and say slightly niche sectors like media and hotels right now. And these are primarily valuation calls.
What about auto ancillaries where there has been favored buying?
So we have a liquidity filter. Unfortunately, most of these companies do not fit into our liquidity filter. And we, as a fund, we primarily focus on liquid stocks. So there might be valuations which might be attractive within the auto ancillary space, but we're not willing to allocate money in this space.
Okay, Nilesh, we'll leave it at that. Thanks so much for taking the time out and joining us and giving us that perspective. Okay.